Welcome back, everybody. It's another episode of Bold Real Estate Investing. I'm your co-host, Chris Angel, here with your host, Bill Dean. Bill, hello out from my multifamily behind me.
Hello again. How are you?
Hello again. I decided to have the same background this time as I did last time because I just love this image of multifamily. So inspiring. Look at that beautiful thing. I love that.
Yeah. Looks much warmer than where I'm at.
I know. Yeah, well, me too. I'm like in the 20s right now.
Oh, perfect.
So listen, I want to know how we're talking about tracking investments. This is really interesting because I have a hard time tracking most things, right? It's like, I'm just glad I got the deal, but now there's stuff I have to track. Like, where do I even start? What am I supposed to track?
Okay. Well, like anything that you care about, you have to keep tabs on it. Yeah. You don't go buy a brand new sports car, park it outside under the tree where all the birds sit, and then leave it for years.
Oh, okay. So let's hypothetically say I don't do that.
Okay. So. Well, I'm just saying that if you're investing in anything really, you need to keep tabs on it. You need to protect it. You need to know what's going on with it. You need to know if it's worth having still.
That's good. Okay. All right.
So just because here today, in 2019, you bought a house and the numbers look great, doesn't mean today, 2022, that's still a great investment.
Right. Good point. Okay.
So one of the things that a lot of people do is they kind of buy it and then set up the systems to protect it. They get the insurance, they get a property manager, and then they just forget about it. And they just text in the mail and never think about it.
Mailbox money. I mean, isn't that kind of the allure? That's kind of the attraction to property. It's like, I just get mailbox money.
Correct. Well, you can do that.
Okay. Yeah.
But things always change. Styles change, conditions change, populations change. I mean, if you were investing in Detroit in the 70s, you had everything set. Fantastic incomes, stable jobs. But you invest in Detroit today, little different picture.
Yeah, got it. Okay.
So, I mean, those are big changes where the cities completely change, but any investment, you have to keep track on it. If you have a financial advisor, they always send you quarterly reports, sometimes monthly, whatever. They're always saying like, oh, this is where you were this week or month or quarter, and this is where you ended. Maybe they have some recommendations. Well, real estate, a lot of people don't think about it that way, but it's a living, breathing creature in and of itself.
That's really interesting because I feel like a lot of times we think of real estate as this really stable thing that doesn't fluctuate a lot. And so like, I'm curious what we're tracking and what things might be different a quarter from now or a year from now.
All right. Yeah, no. So the nice thing with real estate is that it usually is slow. They usually say that like the stock market is kind of does its own thing, but one of the last things to change is the real estate itself. Just because like housing prices change fairly rapidly, but then rent is one of the slowest things to change. Because it takes a while. It's easy to make rent go up if this area is booming and let's say they're building a new Amazon headquarters. Rents will triple in weeks, but to get back down from there, very, very slow process. A lot of times it takes a while for those to make big moves versus if a factory shuts down in the city, you'll see the home values drop in a heartbeat. So there's some things to check. Because most people, when we think of like, when we do the numbers looking at buying an investment property, we're looking at what's the cash flow, what's the ROI, maybe some other numbers therein, like, ooh, what kind of write-offs can I get? I had a great year doing XYZ. Maybe I need some more write-offs. So there's different numbers that we look at on the front end, but we do have to pay attention after we've had the asset. Now, depending who you follow, some people say do it every year. Some people say do it every 2. Some people say every 5 years. Take your numbers and reanalyze the property.
So numbers being like, let's look at the market value. Let's look at the mortgage situation. Look at rents, property, maybe tax assessed value. I don't know. Like, what are some of the numbers that you're looking at?
Okay. Well, you're going to want to look at what was the gross income. Just starting, we thought we could get XYZ. Let's say we thought we could pull in 20 grand with this smaller house. And we only pulled in about 14. Maybe something's amiss.
Yeah, good point.
Maybe not. Maybe you got exactly what you're going for. You can check the tax value, but that would be if for some reason the house is really appreciating. Let's say you are out where the new Amazon is going to be. Mm-hmm. They're going to see big jumps in their taxes because obviously the values are going to jump up with all that demand.
Right. Which would impact your net, not your gross, but it would impact your net, right?
Yes. Yep. Because you're going to have to pay extra taxes that you didn't plan on.
Right.
But that also means you might have to look at the property. Is it worth more generating a little bit of rent, or is it appreciating so fast that I'm better off selling it and taking that money and putting it in a more stable market where it's for the long term?
Yeah, that's a good point. Yeah, if it is appreciating like that, it almost becomes a question: when do I sell? Can I ride this any higher? Can I ride this rising tide higher and get more when I sell, or are we starting to plateau? I mean, I think you'd need an agent or somebody to give you perspective on that. But
yeah, no, that's something too, because you don't want to get I don't want to say greedy. It's really easy to get greedy. I had the oil boom happen here, and housing prices pretty much went up 60% across the board. In some areas they quintupled.
Wow.
And so these people who are barely making $350 rent could get $2,500 for the same 2-bedroom apartment within a year.
Wow.
So I saw everything just go crazy. And it's kind of like they say when you're gambling: know what you want to win and then leave.
Yeah, good point.
So there's people who milked it for all it was worth, got used to making that kind of money. They didn't take their money elsewhere, and then the market crashed.
Yep.
And all of a sudden, oh shoot, well, I wrote checks like I was pulling in the big numbers, and now I can't sell this because no one wants to invest.
Ouch. Right.
So that's why you want to look at it, because maybe it is best to sell when everything's going up, and you could hold on to it and maybe make more money. But if your assets are appreciating at 25% plus a year, you might want to take the money and run.
Right. Yep.
So that's just one of the things. Another way to check or number to watch is to see what your expenses are doing.
Okay.
So a quick rule of thumb is your expenses should be about a third of what your gross income is.
Okay. That's great. Super helpful.
So of course it can be less, but let's say if someone's like, "Hey, Chris, I have this great offer for you. It grosses $100,000 in rent."
Right.
Okay. Well, what's the deal? But you can know that if it's grossing $100,000, probably $33,000 a year is required just to keep it functioning. And
that does not include property taxes, or does it include?
That does.
Okay.
So that number would come out from before you pay for the mortgage. So it'd be in your net operating income.
Okay.
So, you'd have your maintenance fees, your management fees, your property taxes, your utilities, all of that would be figured right off the top from the gross revenue.
Yep.
And then you'd know that you'd have that other 66% for profit and to pay the mortgage. So, that's where you can kind of quickly think in your head, like, all right, so if I have $66,000 a year, $5,000 a month, $6,000 a month, can I cover $1 million loan?
That's so good. I would just tell you my own experience was I didn't think that way. I was just like, well, does it make money? Like, my mortgage is going to be this, the rent's going to be this, and there's my cushion, like there's my margin. And I didn't think about the expenses of it. And that's what got me in trouble with my own investments, was I ended up not being able to float my property when repairs came up or I had vacancies or whatever.
Mm-hmm. No, that's true. Like actually, I was talking to a group today about investing, the kind of this simple math. And a lot of times they say gross income minus expenses, or, utilities and property tax, but really it's all expenses. Right. Something they leave out in a lot of books is pre-planned maintenance.
Right.
So let's say you put on a vinyl siding, and we live in the Tornado Alley, very north end, but we get hail, we get high winds up to 90 miles an hour. So we know that probably every 10 years, they're going to have to do something with your vinyl siding. So
that's even something to your point of tracking, like tracking the condition of your furnace, tracking the condition of your roof and your siding. And like, those are things that could get missed with tracking. I would think I could track. It makes way more sense to track market value, property taxes, but because they're so obvious, but these other things aren't as obvious that still need to be tracked.
Yeah. So the maintenance aspect, so it's, how do I put this? The gentleman I bought my first duplex from, had a folder of every single thing he did with the property.
Wow.
So he knew what he paid for paint back in 1978.
Wow.
He knew what the taxes were when he purchased the home in 1953.
That's amazing.
Everything set up because he was able to look and see like, hey, last time, like he knew that the furnaces were from 68 and he knew that the water heaters were from 2005 and the roof was 2007. Because you know that, well, I should say, kind of a rule of thumb is everything's going to wear out about 15 years, give or take. Carpet, it might make it a month, you know? but like furnaces and different things, water heaters, they all kind of have a shelf life. So if you've had the unit or you know it's 10 years old, you got to start planning that, hey, I'm most likely going to be needing a water heater, or I'm at 15 years of my furnace. I probably only have another 5. I need to start putting that money away ahead of time before I pull my profits and pay for the loan.
Yeah, it's really good. I feel like, especially if you look like the house we live in was built in 2006 or 7, same paint it's had the whole time, and it gets a lot of sun, so it's starting to get sun faded. And it's just like if you don't plan for that, it's hard to cover it. You're like, I don't know, like it's going to cost me probably $3,000 or more to paint the outside of my house.
Yeah, that's going to surprise some people. I mean, me building up, I hand painted, with the help of family and friends, hand painted the exterior of my first duplex.
Wow.
Because it was $4,000 or for $500 of material. I can do it. And 3 weekends of my life hating everything.
The truth is told. That's so true.
I was willing to do it because I knew, like, it wasn't a glorious duplex, but it was the stepping stones that got me to the next one,
Right. Totally.
But like with that tracking maintenance is huge because just like you talked about, it can catch people. Commercially, a lot of times, almost every building I've worked with someone commercially, they ask about the roof. What's the age of the roof? Is it steel? Is it tar? Is it tar and rock? When was the last replaced? Because the expense of doing a commercial roof, like the one you have behind you, you could easily drop $100,000 redoing those roofs.
Right.
So crazy. It makes a difference to know those things. But if you knew 10 years, like, hey, in 10 years, we're replacing this roof, and then any time after that's bonus, well, you're putting that money aside. You're not spending it, so you have it, but also you're making interest on it.
Right.
So you're making some side money. And if you go and sell the place in 6 years, well, now you have a savings account of money that you haven't taken out that you can roll into your profits or whatnot. So it helps in a few ways. Plus, there's some tax benefits, but
I feel like one of the biggest, I'm listening to the conversation and I'm noticing that I'm feeling like one of the biggest distinctions between a seasoned investor and somebody who's kind of getting their feet wet is the emotional attachment to the investment, right? Like it would be easy for me to go into an investment and be like, I see this building behind me. This building behind me is incredible. Like I really want to invest in that. I looked at the mortgage. I looked at like what it would cost. I looked at how much I could make. I didn't think about a roof. I just thought this is so awesome and I've made it. And then I don't consider like maybe the roof is like a year from being shot, or I don't have the reserves I probably should have in order to withstand any storm that comes, right? Like, I feel like this is what separates veterans from novices.
I have some great news for you.
Okay.
One, a great property management company will actually track all of that for you.
Oh, that's perfect. Yeah.
So that is one of the blessings of when you use a good management company. They'll actually say, hey, your furnace is 10 years old. We're thinking about replacing it. And sometimes they'll actually, depending where you are and the competition level, they'll preemptively just, okay, it's hit its time. We're doing it. Like painting your house.
Yeah.
Hey, we had it in the books. We saved up for it. We're doing that this year. And they actually do maintenance, because there's a point when you actually, let's say you own the property outright, you will want to have write-offs to repair and redo, because you're working on the opposite end where you have the money's coming in. You need to find ways of reducing your tax burden.
No, that's really good. I don't think that I would have thought to ask that of a management company. I would just be like, can you market this to get me tenants, versus like, what do you do to actually track my property. I like that. That's great.
Yeah, no, it makes a big difference because they'll help you. They'll let you know even like, hey, this unit's getting a little beat up. We'd like to remodel it, and they'll have the connections hopefully to make it happen, but not be, you know, custom kitchen style. They'll, hey, you know, we get all our cabinets from here. We get a great discount, you know, and they can run that. So there's a breath of fresh air in that you can find those maintenance companies and management companies who will let you know. Yeah, now, really also, some of the other things out there is if you have a tax professional or bookkeeper, they can do it too. At the end of the year, they can give you a report. I call it profit and loss statement. Yep. This is one of the easiest ways to assess what the property is doing, because it will take all the income. So it'll take your rent income. You can even have washer dryers. So, you know, if you have coins, never neglect a washer and dryer. You can sometimes make a few $1,000s extra.
Wow.
And in the economies of scale, let's say you have 8 washing machines and dryer machines. You can pull out maybe $500, $600 a month off them.
Wow.
So
that's awesome. It's incredible.
So yeah, it gets kind of, that's something people might not think about, but it can affect the value of a building up to sometimes $5,000 to $20,000 to even $30,000. So
wow. Yeah, I would not have thought of that. So
you put all the extra incomes in there, and then you start subtracting everything, and hopefully you made a profit. But in there, you'll see, like, am I under that 33% or 35% cost to operate? You know, can we pay ahead on our debt service? Could we maybe pay off something? Or, you know, start looking at that. Hey, what repairs do we need to budget for? Can we put money aside for? And then at the end of the day, you just want to make sure, like, hey, we're, you know, your number, you know, that let's say it costs you $100,000 to invest in the 14-plex.
Right.
Okay. Well, with my $100,000, I made 12% last year, 12% ROI, decent year. But then let's say you find a deal that pays 18%.
Right.
Well, what's the better to have?
Right.
Obviously the 18%. So that's another thing. That's why you want to do these analysis, is because you might be in a great deal, but if you find something better or safer or something that has other benefits, you might actually need to move your money. Right. Not that you're in a bad investment, but you have more opportunity elsewhere.
Do you ever do this type of tracking or analysis with clients? Like, do you sit down and help them kind of think through how to do this?
So usually it's not just me.
Right.
We can talk it over, but a lot of times their accountants will let them know.
Yeah.
Or if they're working on other deals, they'll look back. Because every 2 years, if you look at all your investment properties, you'll have a pretty good idea of like, hey, maybe this one's starting to cost too much to maintain. Maybe it's time to cut it and roll that equity elsewhere. But
I would think that's the kind of thing, like I would want to know, okay, I can ask my accountant about stuff. I can ask my management company about stuff, and then I can bring it in and kind of start to think about it. But at some point I might want an extra perspective that's like yours. It's like, so Bill, this is what my accountant says. This is what management company says. Like, what do you think from a selling standpoint? Like, how's the market? Can I sell it? Should I sell it? Should I keep it? And I have just another perspective from the sales side of things, you know?
Yes. Now that is actually a fantastic point, because you do need to analyze that too. Like we talked about the appreciating market, maybe, you know, returns are okay, but it's probably, you might be better off selling it for a tax purpose, an income reason, or maybe it's just the building's run its course, because you can only write off a building for 27.5 years.
Yeah.
So even after that point, there's no point really holding it.
Or and to our last episode, like going back, maybe there's an opportunity at 1031, make the market, the thing you would move up to, that market is somewhat depreciated, while this single family market has been rising, but the commercial side has been softer. And so maybe there's a 1031. I mean, there's just options that I think you need to talk to somebody like Bill on that side who can speak to those things as well.
Yeah. So like if you were to come to me, Chris, and say, here's my portfolio, what do you think? What should we look at? We would look and do an analysis of what they're worth on paper and in the market. So you kind of do a couple different valuations, and then you need to have some goal of what you want. So usually a financial planner or your accountant will have an idea of where you are, and then your banker will let you know too what is possible. And that way you can really game plan, because maybe it's time to move into something where you're just a partial owner with a bunch of people, and you don't have to do any headaches. All you do is get a check.
Yep. So good.
Or maybe it's time to be a little more aggressive. You're looking at retiring and you want to kind of move into something that can pay a little bit more.
Yeah.
Whatever the needs are. But we look at it, what the value is, what it could be as a sale. Sometimes it might just be better to refinance, roll some equity into something. So it's really kind of custom designed, and I need to know where they want to go.
Yeah.
Like if you say, Bill, I made it, I'm headed down to Arizona or Mexico or wherever you want to go.
Yeah.
I just need $60,000 a year coming in that I don't have to worry about.
Yeah.
Go to work.
Okay. Right. Yeah, absolutely. I love that. It's so good. I never would have thought of tracking. I don't know. That's probably naive of me, but I think that sometimes there's these things that seasoned investors have experience with where they're like, yeah, don't forget to track. And you're like, track what? What am I tracking? It's just really good that you have this experience. I love it. Well, listen, is there anything else you want to say about tracking investments before we sign off?
Yeah. Real quick. I mean, the nice thing is you can use tools as easy as Google Docs or Google Sheets. It's free. Just put in your numbers. Every time you write a check to fix something, just put it in. At the end of the year, just add up all your bills. Yeah. See what your profit was.
Got it.
As easy as that now. I mean, like I talked about, the first guy I bought a house from had a paper folder because he didn't use the internet.
Right.
We're a younger generation. In fact, there's a lot of tools out there now for real estate investors. The thing is, when it comes to tracking, most people only talk about acquiring property. They don't tell you about the maintenance side.
Right.
So like there's a tool, I haven't quite used it yet, so I'll hold off on a little while, but there's different free softwares that actually will track your individual investments for you. You put the name, you'll pull Google Earth, take a picture of it.
No way.
And then you can even sync it to your bank accounts, and every time something goes to something, you can allocate it to that rental or this unit.
That's
and
awesome.
It tells you, hey, your gross was this, your NOI, net operating income was this, and your cash flow this year was XYZ.
Wow. We should do an episode on just some of the tools around helping manage your investment portfolio for sure.
Oh yeah. Well, don't just set it and forget it. You want to pay attention to some of these things.
Don't set it and forget it.
You can actually have bad management companies who won't let you know that it's getting neglected. And then all of a sudden, oh, we can't get this rented. Well, what's wrong with it? Well, there's a hole in the roof that leads all the way to the basement.
Right.
What?
Yeah. What? Right. That would be another interesting episode. Just what to look for in a management company. Like, because you said it earlier and I was like, oh, I didn't know I could ask a management company about that tracking. Like I just wouldn't have known to even think about that as a question to ask them. But
oh yeah. Yeah. We can definitely talk about that because interviewing, I mean, they're your partners. So you,
right. Yeah, of course.
Take them on a few dates before you figure out what you're going to do.
That's so good. I love it. Awesome stuff, Bill. Well, I know people listening to this will want to reach out to you and kind of pick your brain for how to track and not just track, but how do I elevate my investment portfolio, which is what you're so good at. How do people reach you?
All right. Reach out to me at Bill Dean Homes. So my name, homes.com, and click on the comment section. Send me a little message or note, and I'll reach out to you because it's nice to have a little help when you're digging around for this stuff or looking back at a portfolio. So
absolutely. Yeah, it's so good. Awesome. Thanks, Bill, again for your wisdom and your expertise. Until next time.